Imagine waking up tomorrow with an extra $50,000 sitting in your bank account. No debt, no strings attached, just $50,000. What would you do with it? Most people think they already know the answer. Some would say buy real estate. Others would say invest in the stock market. And both sides are convinced they're right. But what if I told you two people can start with the exact same amount of money? Make completely different decisions. And 20 years later, end up with almost the same net worth? Today we're following two friends. One chooses rental real estate, the other chooses index funds. We'll track every major decision, every mistake, every advantage, every hidden cost. And by the end, you'll see why the real winner isn't who most people think. Meet Ethan and Noah. Both are 30 years old. Both earn around $55,000 a year. Both have spent years saving. And finally, they each have $50,000 ready to invest. One Friday evening, they're sitting in a small coffee shop discussing the future. Ethan has been watching real estate videos for months. Everywhere he looks, people are talking about rental properties, passive income, financial freedom, cash flow. The dream sounds incredible. Noah has been reading investing books. His strategy is much simpler. Buy index funds. Hold them for decades. Ignore the noise. Ethan laughs. That's boring. Noah smiles. Maybe. But neither changes their mind. So they make a deal. 20 years from today, they'll compare results. A few weeks later, Ethan finds a rental property. It's a modest 3-bedroom house. Nothing fancy. Nothing luxurious. Just a solid house in a decent neighborhood. Price? $250,000. He uses his $50,000 as a down payment. The bank finances the rest. The moment he signs the paperwork, he feels different, powerful. For the first time in his life, he owns real estate. He isn't just saving money anymore. He's building wealth, or at least that's what he believes. A month later, he finds a tenant. Rent begins arriving. Every month, his phone buzzes. Another payment. Another step toward financial freedom. His friends are impressed. At parties, people ask questions. How's the rental going? Thinking about buying another one? Must feel good owning property. And honestly, it does. Meanwhile, Noah logs into his brokerage account. He invests the entire $50,000 into a broad market index fund. Then he sets up an automatic monthly contribution. $300 every month. That's it. No paperwork, no inspections, no tenants, no excitement. When coworkers ask what he's investing in, he says, index funds. The conversation usually ends there. Nobody is impressed. Nobody thinks it's interesting. There are no exciting stories, no house to show people, no rental checks to brag about, just numbers on a screen. And for the first couple years, it feels painfully boring. Year 1 arrives. Ethan seems to be crushing it. Rent is coming in. The property has gone up slightly in value. He's building equity. Everything feels productive. Every month looks like progress. Noah checks his account. Some months it's up. Some months it's down. Sometimes it drops for no reason at all. The stock market feels random. And because humans judge success emotionally, most people would say Ethan is winning. After all, real estate feels real. You can touch it. You can see it. You can drive past it. Stocks? They're just numbers. At least that's how it seems. Then one evening, Ethan gets a phone call. His tenant sounds frustrated. The water heater stopped working. No hot water. The repair bill? Over $1,000. Not fun, but manageable. A few months later, another call arrives. A plumbing issue, more money, then another. And another? Slowly, Ethan begins learning something nobody talks about on social media. Rental income isn't profit. Rental income is revenue. Profit is what's left after expenses. And expenses never stop. Property taxes, insurance, maintenance, repairs, vacancies, unexpected emergencies. Every property owner eventually discovers the same truth. The rent check isn't yours. Not all of it. Despite the challenges, Ethan still has a huge advantage: leverage. This is what makes real estate so powerful. Think about it. He only invested $50,000, but he controls a $250,000 asset. That's 5 times larger than his original investment. Imagine the property rises just 4%. That's a $10,000 increase in value, a 20% gain relative to his original cash investment. That's why people love real estate. Leverage magnifies success. But here's the part most beginners ignore. Leverage magnifies mistakes too. If the property drops in value, the losses feel larger. If expenses rise, the pain feels larger. Leverage is like fire, useful when controlled, dangerous when ignored. 3 years go by, then 5, then 7. Life gets busy. Ethan changes jobs, gets married, moves houses. Yet the rental property remains. Sometimes it performs well. Sometimes it causes headaches. He's dealt with late payments, maintenance requests, vacancies, and one tenant who seemed determined to test his patience. Yet through all of it, the property keeps slowly increasing in value. His equity grows, little by little, month by month. Without realizing it, he's becoming wealthier, just not as quickly as he expected. Meanwhile, Noah's strategy remains unchanged. Every month, $300. Automatically invested. No excitement, no drama, no emergencies, just consistency. And then something interesting begins to happen. The account starts growing faster. Not because Noah invested more, but because compounding finally starts waking up. Most people quit right before compounding becomes powerful. And what happens next completely changes the race between Ethan and Noah. Around year 8, Noah notices something strange. His investments are starting to earn more money than he contributes. Think about that. For years, he added money every month. Now the portfolio itself is generating growth. Without extra effort, without extra work, without extra time. This is the stage where compounding becomes visible. Imagine rolling a snowball downhill. At first, it barely grows. You push. You wait. Nothing exciting happens. Then suddenly the snowball becomes massive, and it starts growing faster than you can push it. That's compounding. Most people quit before reaching this stage. Noah didn't. So now he's seeing the rewards. Then disaster strikes. The stock market crashes. News headlines become terrifying. Experts predict doom. Investors panic. Everywhere Noah looks, people are selling. His account falls dramatically. Years of gains seem to disappear. For the first time, he questions everything. What if he was wrong? What if the market never recovers? What if all those years of patience were wasted? The temptation to sell becomes overwhelming. But Noah remembers something he learned years ago. The market has crashed before, and every time, eventually recovered. So instead of selling, he does absolutely nothing. The hardest investing decision of his life is choosing not to act. At almost the same time, Ethan faces problems of his own. A tenant moves out unexpectedly. The property sits empty. Weeks pass. No rent arrives. Yet the mortgage still needs to be paid. Insurance still needs to be paid. Property taxes still need to be paid. Then comes another repair. And another. And another. Suddenly, the rental property doesn't feel like passive income anymore. It feels like a second job, a stressful one. Still, Ethan refuses to quit. Because despite the challenges, he understands something important. The property itself keeps increasing in value over time. As long as he survives the difficult years, the long-term math remains in his favor, so he keeps going. 10 years pass. The friends meet again. The same coffee shop. The same conversation. But this time they have real results. Ethan's property has appreciated significantly. His mortgage balance is much lower. His equity has grown dramatically. Noah's portfolio has also exploded upward. Years of compounding have transformed a simple investment account into a serious asset. Then they compare numbers, and something surprising happens. They're much closer than expected. Neither one crushed the other. Neither strategy dominated. Both worked, just in different ways. Ethan built wealth through leverage. Noah built wealth through compounding. Different roads, similar destination. But money isn't the whole story, because every investment has a hidden price. For Ethan, the cost was time. Phone calls, repairs, tenant issues, stress, responsibility. For Noah, the cost was emotional. Watching market crashes, ignoring scary headlines, trusting a process that often felt invisible. Both paid a price, just different currencies. One paid with effort, the other paid with patience. Most people watching this are looking for the best investment, but that's often the wrong question. The real question is, which investment can you stick with? Because an average strategy followed for 20 years beats a perfect strategy abandoned after 2. Think about it. The greatest returns in the world mean nothing if fear causes you to quit. The smartest real estate deal means nothing if you get overwhelmed and sell. Consistency beats brilliance more often than people realize, and that's exactly what Ethan and Noah accidentally discovered. 20 years after their original bet, they meet one final time. They're both 50 years old now. Life looks very different. Ethan's property is worth far more than when he bought it. The mortgage is nearly gone. Rent continues arriving every month. Noah's investment portfolio has grown into something he once thought was impossible. The gains now generate more wealth annually than his salary once did. Neither became a billionaire. Neither bought a private jet. But both achieved something far more important. Freedom. Freedom to choose. Freedom to work less. Freedom to spend more time with family. Freedom from constantly worrying about money. And that was the goal all along. After comparing 20 years of results, Ethan laughs. You know what's funny? What? Noah asks. We spent 20 years arguing about which investment was better. Noah smiles. And the real answer was neither. The truth is, the best investment wasn't the property. The best investment wasn't the index fund. The best investment was the decision to start. While most people spent 20 years debating, they spent 20 years investing. While others waited for the perfect opportunity, they took action. While others searched for certainty, they accepted uncertainty and moved forward. That's why they won. If you're constantly asking whether real estate is better than stocks, you're probably focusing on the wrong problem. The difference between investing and not investing is massive. The difference between two good investments is often much smaller than people think. So stop searching for perfection. Stop waiting for certainty. Stop trying to predict the future. Pick a strategy. Stay consistent. Give it time. Because 20 years from now, the investment you choose may matter less than the fact that you chose one at all, and that's a lesson worth remembering.